All right, everybody, welcome back to the Financier. We're celebrating Entrepreneurship Week, National Entrepreneurship Week. So we did a lot of streams earlier on the week. Suresh Kumar from NJIT, Parth, who runs Startup Tribes. We had a few other people, Paul Lopez, to discuss venture capital. It was very exciting. We have a couple more lined up for the next few weeks. As usual, I'm trying to host this Financier Fridays, along with the newsletter that was released this morning. If you haven't checked it out, it's available on LinkedIn or at thetechfinancier.com. Today, we'll talk about SPACs and investing, what's happening in the markets. I think people may also want to talk about GameStop and the hearing yesterday, what happened. I watched some clips of it. It was a 5-hour hearing, probably one of the longest that's ever taken place in Congress in the current times, and most attended. There are over 9 million people in the subreddit group discussing Wall Street bets, interesting ideas. That's how the GameStop idea was generated. So there might have been hundreds of thousands of people just watching the hearing from the retail community, which is definitely unique. Usually it's just institutional investors and people who watch CNBC. So if you have any questions about that, I'd love to talk about it. If you got any questions about the newsletter, also let me know. Today, we'll talk about SPACs, the structure, how they go into market, why they exist, and some of the top fund managers. I've also released a slide deck this morning about the structure, so you can look up this 30-page deck about what's going on behind the scenes. So there's no surprise that the market has gone up a significant amount in the last 12 months. The number one reason is because of the stimulus plan. Got trillions of dollars going into the market today. It's a big swing. It's a big bet. Janet Yellen, who just mentioned yesterday that there's some concern about inflation rising in the future. It's one of the main catalysts for why Bitcoin and other cryptocurrency assets are taking off in the markets. Inflation is going to impact a lot of assets that are not hard, anything that's not correlated to the stock market. So we're talking about real estate, gold, commodities, and then crypto is obviously the hottest one. So aside from that fact, let's talk about SPACs, the alternative way to get public. One big fact that's taken place in the last 20 years is that we've seen half the number of companies stay public. They've gone private, or they go out of business, become too small, delisted. And more companies are becoming private. Alternative funding sources have become readily available. Venture capital has become more accessible. It's easier to invest in these businesses. So SPACs are actually not a new idea. They were invented in the 1980s and 90s. They've been used. They're more shady in tactic. They're blank check companies designed to raise capital to take companies public. It's designed to acquire a private business, so it merges. The SPAC will close a deal within a 24-month time period. Investors will take this capital and put it in a trust. And then if the deal takes place, they use that capital to take the target company public. If it doesn't take place, then the capital is returned back to the investors with some interest income. So in the 90s and the 80s, the SPAC market was fueled by smaller investment banks. It didn't have much oversight. There were, in some cases, there were fraud. There weren't reputable sponsors, which is what has changed today. There's more oversight that probably took place in the 90s as we saw the dot-com era fuel. There have been hundreds of SPACs that have taken place, but this really hasn't taken off since 2019. It's definitely picked up in issuance. Usually in the past, we've seen volumes in the ranges of, let's say, 10, 20, maybe 30 SPACs a year. Not that much. The average SPAC is generally around $300 million. I'll get into the reasons why later in this video. But it's a very small market. It's nowhere near the size of the IPO market. So equity issuance, secondary offerings, debt offerings, anything happening in those other markets are way larger than this alternative vehicle. But a few years ago, this became a very popular exit strategy. The first catalyst I'll discuss is that venture funding in the last 8 years, 10 years picked up. The valuations are off the charts. But the problem with venture capitalists is they focus on the really high growth companies and they're willing to invest in losses for the short term. But eventually that momentum will run out. It will die down in a very short period of time, let's say 3, 4, 5 years, and they need to figure out a way to monetize their investment. Going public is a popular strategy for a lot of these guys. So that inflection point is difficult for investors to grasp as you move from private equity base to public markets. And the IPO process actually has so many different variables involved. It's really difficult to get a company public at a valuation that you want. If your company, unless your company is really big, so like Airbnb, DoorDash, those are top 3, 4, 5 names. In the example of WeWork, it was a brand name company that had a lot of problems, and they were exposed during the IPO process, and it went from 40 billion to 10 billion or whatever the valuation is today. So in the IPO process, there's a lot more rigor. There's more due diligence taking place, and investors are of a higher caliber. They're institutional guys coming in, writing checks, 50, 100 million plus to back an IPO. The problem from that is that the retail investors don't get an allocation in IPOs in most cases. Top firms, Fidelity, Goldman will get allocations to their clients. They'll make the money. The stock will jump because it's been oversubscribed and it's undervalued because banks get paid on performance. So if an IPO does really well, they're leaving money on the table, but it looks really good because it was so oversubscribed and there's a lot of excitement around it. Add on the fact that there are less public companies available. There are about 4,000. There are about 15,000 10, 20 years ago. So investors have fewer options to get behind really good investments. So they all crowd into these hot stocks, even if they still lose money, like Palantir, Airbnb, Uber, doesn't matter. People want to get behind hot names. So SPACs solve this problem really for the higher middle market, that one multi-billion-dollar range. These are fully funded investment vehicles designed to merge the private companies. And the one caveat for a fund sponsor, though, is that they can't pre-screen investments. They can't talk to investments beforehand. They can't say, I know the CEO, he's going to sign a deal, we're going to take him public. The SPAC is really a blank check. It's a blind trust format. I can go out to market, raise $300 million, and on day one, I have to begin the search process from scratch. Now, it seems really easy. It seems amazing. There have been over 91 SPACs that went public in January alone. They raised $38 billion in 1 month. We did about $70 billion in 2020. So we did more than half of all of 2020's funding in 1 month. I think that momentum is going to continue for the next few months. It's definitely a record. We've never seen so many. 91 were IPO'd last month, but another 91 are in the pipeline. So we have a lot of momentum carried out. But there are a couple problems when you have so much capital available to deploy. You have to figure out how to invest it. So SPACs have a 2-year window. It's a short window in this investment world because when you're doing 9-figure deals, 10-figure deals, you're required to do a lot of due diligence. And if you recall, I mentioned that in the IPO process, the bankers and the institutional investors would do the due diligence, and basically retail investors would coattail on their hard work. In the SPAC world, you can't pre-screen investments. You have a public company. It's ready to invest in, and you are betting on that the fund sponsor. So in cases like Chamath, who runs Social Capital, you're betting that he's doing his due diligence. He's a really good investor, and he's going to make really good investments. That may be the case with Chamath, but there are hundreds of other sponsors, hundreds of other SPACs that are in the market. You don't know who they are. They're buying these big businesses. Churchill Capital is an example that acquired Lucid Motors a few weeks ago or last week. So let's take a moment, break down the structure. You have 2 years to make a deal. To do a 9 to 10-figure deal will require at least 6 months of due diligence. You're starting from scratch on day one. So you're going to take the next 6 to 8, 9 months looking for a deal. You're going to shop. You're going to speak to hundreds of CEOs. You can't simply just get married on the first date. So you need to make a deal in the first few months. at least have an idea. Because if you fail on a deal, you have to take a couple months to recover from that deal. Now, SPACs can be extended to 36 months. This is not always the case. The board has to make the decision on this if it makes sense. If they don't like it, the investors don't like it, they simply close the SPAC and they take the money out of the trust and they just redeem that money and they close this investment out and they can just reinvest it elsewhere. They lost on the opportunity cost, but they had that free call option betting on an investor or the fund sponsor to make a deal. Now, if you do go out and make a deal, you have to do the due diligence, you have to do the search process, and then the acquisition. So in most cases, it takes 18 to 20 months to do a deal. In the case of why founding teams or sponsors will go out and invest the initial capital. So to give you an example, $200 to $300 million is the average SPAC size. The founding team fund sponsor will go out, put up maybe a couple $1 million to pay for the fees, let's say the banking fees, legal fees, the advisory fees to make a public entity. They're going to risk basically 2 years of working capital. So it's a couple $100,000 a month, and they have to spend money on due diligence. So they put up a lot of that equity capital, but in return, they'll go out and find large investors, let's say hedge funds, private equity, other institutions, to say, we'll back the initial acquisition equity capital, which will be $300 million in this case. So the fund team, the fund sponsor team will put up, let's say, $10 million for due diligence over 2 years, which is a couple $1 million a year. And then they'll say, let's go raise out $300 million from funds. That $300 million is put into a trust. It's kept there. It's earning interest. It's not touched until an acquisition is decided upon. Once the board and the committee decide to make a deal, then that $300 million will be unlocked, removed from the trust, and used as firepower in this case to acquire a company. Now, the real incentive for the founding team is that they get about 20% of the equity after IPO, which is known as a promote. So they get a really big piece, a big chunk of the business. It's very attractive for them. They want the deal to close. They want the deal to succeed because they only put up a couple $1 million. They get hundreds of millions in leverage, and then they can actually use even more money as debt. So they can technically buy a $500 to $1 billion business with just about $200 to $300 million in equity capital from other investors. You'll see that SPACs consist of units. So this is pretty standard process across the board. They're made up of shares and warrants. They're set at $10 per unit. These warrants are where the money is really made. They're long-dated options designed to incentivize investors to hold for the long term. You know, one of the problems with IPOs is that after the window is closed, let's say that I think it's a 60 or 90-day window, investors and shareholders want to sell to receive liquidity. So in the case of SPACs, they have warrants and other options built in to the investment vehicle, so people will hold it for multiple years. So this is important. This is a really big distinction from regular IPOs. If you want to look at the illustration of the entire SPAC process, from the search, selection, to the acquisition, I recommend checking out the newsletter from this morning. I have a couple of diagrams breaking out the 24-month runway. It's very simple. It's not complicated. The most challenging piece of a SPAC is actually closing the deal. So I will recommend, or I'll suggest that don't blindly invest or look at all the SPACs across the market. I will mention 5 of the top 6 of the top managers in the space today. But you know, one of the billionaire investors that I follow, Sam Zell, said that SPACs are starting to remind him of the speculation period in the dot-com era in the 1990s, when people were simply buying companies because they had good names, good managers, but the businesses behind the scenes weren't making any profits. And one big example was Nikola Motors from earlier this summer, when the company has $9-10 billion in market cap, but it produces no products, has zero revenue. Last week, Lucid Motors is another electric company that came to market. It also doesn't have a track record yet, especially if you compare it to Tesla. So it's pretty concerning that hundreds of billions of dollars are being raised, but there's a high likelihood that a lot of those deals will not close, and the money will just be redeemed back to investors. So it's not a real bubble in this sense that people are simply going to lose money. It's just that a lot of money is going to be invested in the space, and then it's just going to be poured right back to investors because they won't be able to close deals. At the end of the day, there's so many limited number of big deals, in the 500 million, 5 billion space. Everybody's talked to them. Everybody's shopped with them. All the CEOs know they're available for sale. You could talk to all the investment funds. All of them they would love to sell their companies, but they're looking for the highest price and they're looking for the best price with the best team. So when it comes down to active managers, I'll mention a couple of them right now. You can look them up on SPACtrack.net. But first up, these guys have done multiple deals, or if not, they've been very successful in investing. So they have a great track record. Apollo Strategic Growth Capital is managed by Apollo Global Management. They have multiple tickers. You can find all the tickers in the newsletter from this week. Michael Klein, he's number 2, is a former Citigroup executive. He's a sponsor of Churchill Capital, Social Capital by Chamath Palihapitiya. He's bought every single IPO name from A to Z, so it's really popular in his space. He's really brought the industry back 2 years ago when he started doing IPO A, B, and C. Pershing Square Tontine Holdings. This is a big deal that took place over the summer. It was run and managed by Bill Ackman, the billionaire investor. It's the largest SPAC in the market today. It has $5 billion in buying power. So he'll definitely do a major unicorn deal. The Gores Group, they have a couple notable SPACs that are a major private equity firm based in California. And then another last one I'll love to mention is Reid Hoffman, the co-founder of LinkedIn. He's done 3 so far, I believe, in the last 6 months through Reinvent Technology Partners. So this is a really big revolution. If you have any questions, feel free to ask me about the markets or investing. I think SPACs are here to stay. America has the deepest and most liquid financial markets. So this is a competitive strength for the US. Other superpower countries like China and India simply don't have access to the capital we do. So to raise hundreds of millions of dollars to go out to market, to acquire, then to have retail investors come out, fuel those investments, make them exciting, get behind the story stocks, and make those ideas profitable and work. It's never been done anywhere else. A lot of other companies and other countries come to the U.S. to go public. Alibaba did this in 2014 with their IPO, which was the largest at the time. So investors love investing in the United States. I think this will remain the case. SPACs will continue to happen. There will be fewer of them going into the future. And I recommend studying the top managers that I mentioned. Check out Chamath. He's definitely one of the best in the game. I would also recommend checking out what the difference in IPO was versus direct listings versus SPACs, what the impact is for companies in the marketplace. The biggest impact really is that the IPO process has been broken. The oversubscription is leaving a lot of money on the table. So SPACs and direct listings are doing a great job of unlocking this. One recent example is that Spotify did a direct listing well before the SPAC bull run took place in 2019. So companies are looking for different ways to provide liquidity to their employees, to their shareholders, and to the founding team. So I think this is a really good way. It's democratized access to capital. There's a lot more to come from this. I recommend checking out the Reddit subreddit called SPACs. The link is in the newsletter today. It is one of the fastest growing groups in 2020. I don't have to tell you that the story behind Wall Street Bets is the reason why AMC, GameStop, all the popular companies went viral in the last 30 days and hit record highs. Retail investors are really fueling the future of investing. So I recommend paying attention to these trends. Check out the SPACs subreddit group. Look at what's happening behind the scenes, what people are picking apart, what they're analyzing, where the due diligence is taking place. Look for the transparency in these investments. People are going to do the hard work for you. You don't need to rely on the institutional investors, the top funds the people that you actually can invest in because you may not be accredited, check out these groups. These people are really doing a lot of work. People have a lot of time. They have access to capital. Stimulus funds are coming in, and people want to make money. And the retail investors have been loud and proud about this. Yesterday's hearing with the GameStop congressional hearing to discuss from discussions from the CEOs of Reddit, Citadel, Robinhood, and then obviously Keith Gill from Wall Street Bets, the Roaring Kitty. They all talked about different angles of the market. There was a representation from retail, hedge funds, institutional, pension. Everybody was there to the brokerage accounts. And it was really important to learn about where the market forces are going, where they are, and who is making the money. So definitely check out this Reddit group. It's very exciting to hear about this. It's very exciting to see the CEO of Reddit support these guys. They want to see people invest and succeed in this space. So that's really it for today. I really wanted to talk about SPACs. It was a really big topic. It was requested. It's been popular. A lot of people have asked for it. There's a lot more in the horizon that I want to cover in investing, but I can't do it without you. So I want to know what you want to listen to, what you want me to cover, what content you want me to provide. Always, you can find me on LinkedIn and Twitter. Follow, contact me. I'm active on all the platforms. I answer questions on Quora every day. So you can always ask them right there indirectly or anonymously. And then you can always message or email me as well. I'm very accessible. So thank you, everybody, for joining in again. So until next time, Financier signing off. If you have any questions, feel free to reach out and message me anytime you like.